Well, these stocks have a lot of newfound momentum, and a lot of money continues to go into them. I'm looking at Apple at 147. It's $3 away from its high. Josh has pointed out some of the gains in these other stocks of late. There's days that go by where we say such and such stock, Microsoft, new all-time high today. Google, new all-time high today. Amazon, new all-time high. Apple approaching a new all-time high.
Yeah, and the only point I wanted to make is that, and I'm not trying to parse my words here, is that I believe the recovery is over in terms of the big bump from what the pandemic did, which was really depressed demand. Now I think we're in a normal economic cycle where it'll move higher. So I don't think the stocks are done going up. In terms of the FANGs, look, those are all weather stocks. Those are all market kind of stocks. And I don't think you trade around them except unless there are exogenous events going on, perhaps because of Facebook with antitrust. So I don't see that as a real threat. So I own those. I've owned them for a long time, been in and out of Facebook, but the others, I've been there forever and I will. And as you look at stocks and your portfolio and you look at just the overall market, what stocks always work out and continue to go up? Okay, we talk about super cycles in commodities. Guess what? They go up, then they go down right to where they are. We talk about chemicals, same thing. We talk about airlines, the same things. But what always move up? The technology stocks, and particularly the FANGs. So that's why it makes up collectively the biggest part of my portfolio.
I'm shocked, though, to hear you say, Steve, that you think now we're in a quote-unquote, because I wrote it down, I was so surprised, normal economic cycle. How can we possibly be in a normal economic cycle if we're literally just getting out and starting to live our lives on the other side of a pandemic that's kept us in the house? It's kept us off airplanes. It's kept us out of hotels and theme parks and movie theaters and casinos. And I could go on and on. How is this normal?
Because the stocks are discounting mechanisms and they moved up in advance of it. So
yeah, maybe they're underestimating.
Earnings that are increasing by possibly, but you have, I'm not saying growth is stopping again. I'm saying it's going to moderate. And I don't think it's going to moderate in the quarter we're in because you still have those very easy comps. But you've never seen a period in time in history where ad infinitum you had year-over-year earnings growth of 60%, which is what we have this quarter. So I think you go back to traditional earnings growth, not this quarter again, maybe not next quarter, but definitely next year. You'll see us go back to what companies typically do, with the exception of 5G and where there's continue to be innovation.
Pharma Jim, help me out here.
Yeah, well, look, he's not off, right? It's tautological to say you can't grow at 60% per annum, but this ties right back into Mike's sort of central thesis of demand pull forward. Let's say you did pull forward demand, and that's being reflected in 65% year-over-year earnings growth. If that's the case, look, that means this year's earnings could come in around $200 on the S&P 500. You're only at 21 and a half times this year's earnings. If you get even 8% growth next year, which is way below where estimates are, you're going to be below 20 times on next year's earnings. And I'm going to tell you the market's cheap with where interest rates are, where stimulus is, where the Fed is. I just think the demand pull forward, which both Mike and Steve are now saying, I don't think that means that you have lost that much demand from next year. And relative to prices, look, Mike, actually, you said it wisely. You said if you're investing over the next 5 to 10 years, which all of us should, then this is noise. And I think the discussion of a correction is noise. You are supposed to be invested. I have almost every dollar invested at this point in time.